Welcome to our channel. If you want to manage investment risk, follow these step-by-step instructions to protect your portfolio while pursuing growth opportunities. Step 1. Understand your personal risk tolerance based on your financial situation, investment timeline, and emotional comfort with market volatility. Be honest about how you'd react to significant portfolio losses. Step 2. Diversify broadly across asset classes, sectors, and geographic regions. Never put all your money in one investment or asset type, regardless of how confident you feel about it. Step 3. Match your asset allocation to your time horizon. Longer time periods support higher stock allocations, since you have time to recover from market downturns, while shorter horizons require more conservative positioning. Step 4. Maintain an emergency fund separate from investments, covering 3 to 6 months of living expenses. This prevents forced selling of investments during market downturns to cover unexpected costs. Step 5. Rebalance your portfolio annually to maintain your target allocation. Market movements cause drift from your intended risk level, and rebalancing enforces the discipline of selling high and buying low. Step 6. Avoid trying to time the market by moving in and out of investments. Missing just a few of the market's best days dramatically reduces long-term returns. Step 7. Stay informed, but don't let daily market news drive emotional decisions. Focus on your long-term plan and goals rather than reacting to short-term volatility. Don't forget to like this video and subscribe to our channel.